All right, China continues to rattle a lot of the global markets, and it's rattling them because they put out a number that sounds a little specious at face value, saying that they grew in the third quarter at a 6.9% clip. Now, we might find that to be an envious growth rate, and it would be about 3 times our own growth rate. Having said that, though, 6.9%, if you pick apart the individual data, you'd have a hard time coming up with how an economy grows, even at that clip. Having said all of that, the feeling seems to be that China is slowing down. Its once hot real estate market is cooling down. And that, as Bob Wiedemer saying, well, many in the world have reason to feel a little bit rattled. It is obviously impacting oil prices, obviously, as the demand subsides. But, you know, Bob, I don't believe these guys. I didn't believe them when they said they were going at a 12% clip. They're like the John Lovitz of the international community, right? I mean, you just cannot buy what they're saying. So should we be really worrying as much as we are now?
Oh, I think we should be worrying more than we are now. I'm amazed that people take even the 6.9% they're saying with any grain of truth. You're right, 12%, 10%. To do this year after year in a large economy like that, it's ridiculous. And if you look underlying it, did you know that China's bank debt has actually doubled since the financial crisis? It now has more bank debt outstanding than the U.S., twice as much as the U.S., yet their economy is barely half our size. Come on.
All right, so what do you think is a realistic growth rate? I've heard economists peg it at half that, a quarter that, what? What is it?
Yeah, I think it's more like a quarter that and heading into recession. And I think that's what people don't want to admit, is this economy is very likely heading into recession, something they can't imagine, given its dictatorship is going to tell you something different or plan something different. But I think it's heading into recession. A quarter that would be a good guess.
All right, so the fear, as you know, Bob, and you've expressed this well in the past, is that as China goes, so goes potentially the world. It's a big market that sort of freezes up on us, and it's a start of a contagion. We've already got signs out of Japan that their third quarter GDP could be very, very weak, that this is part of a regional and now global issue that we don't appreciate. Do you agree with that?
No, no question. I mean, Brazil, again, another country that's been very dependent on Japan, having real trouble. Even Canada. Canada is flirting with recession, and that's partly because of low commodities prices. It's hurting everything. It's certainly hurting our stock market. But the idea that it's going to rebound in the next year or two because China's going to do more stimulus is sort of silly. That's what's gotten to where they are, is massive stimulus already. I don't think it's going to rebound because of more stimulus.
All right, let me give you another worry that they own a lot of our debt, I think $1.3 trillion worth, and they've already been getting rid of a lot of that. In the scheme of things, small, about $100 billion, but it could pick up, right?
It could pick up. I mean, there's no question they're under pressure with their currency. That could cause more declines in the reserves, more selling of bonds. So you're right. It's not just the economic issues from lower demand and lower exports, lower imports, but absolutely the effect on the currency markets, the effect on our stock market, their stock market falls, no question.
We get pretty cocky here in this country, Bob, about, well, where else are investors going to go? We're still the best bet as far as investing in our Treasury paper, even if we're at 0% rates, because we're stable. We're stable. What do you make of that?
Well, we are stable, but that's assuming we're always stable. I mean, the reality was mortgage bonds were a great deal in 2006. People were jumping all over them because,
you're right.
Remember, they had no risk and they got a nice return on them. So all over the world, people were buying mortgage bonds in 2006. 2008, they were totally toxic.
Thank you, my friend. Very good having you again. Bob Wiedemer. Now, on to other developments.